Bismillahirrahmanirrahim. In the previous class, we discussed about verification and vouching. We discussed about the definition of verification, that what is basically verification. Then we discussed about vouching, that what is vouching. Then we discussed about techniques of verification. And then after that, we start this topic that was advantages of verification. In this, we discussed about that with the help of verification, we can prevent fraud, then we can evaluate performance, then proper use of asset, safety for creditor, protection to the lender, proper valuation of assets, proper recording. So we discussed up to proper valuation of assets. That is, verification is useful for the assessment of asset value. There are two types of assets, fixed and floating. You know about these. Both the assets are verified in different ways. Due to verification, the correct valuation made by the auditor. So, with the help of verification, we can give proper valuation to assets, whether these are fixed assets or these are floating assets. Then the next advantage of verification is proper recording. Verification is useful for proper maintenance of record. So now you know that if the management knows that auditor will come and he will check the record, so he will keep proper record of each and everything. Management knows that all the accounting informations will be verified by the auditor, so they keep the record properly. Because the management and all the employees of the company, they know that auditors will come and they will check each and everything, they will check the record, so they are keeping record properly. Benefit for public. Now, what is the advantage of verification to the public? For public, the people can understand the exact financial position of business by the verification of auditor. So why people needs to know about the company? Why people, public, wants to know about the exact financial position of the business. Some people, if they want to invest their money in the company, so they will get exact picture. They will get information about the exact financial position of the company. The auditor discloses the assets and liabilities to the general public in his report, which provide guidance to them. So here, guidance means guidance in investment. If they want to invest, if they want to purchase the shares of this company, so the general public can get information from the auditor's report. So it is a benefit for the public. The benefit of what? Verification. If books are verified, if company assets and liabilities are verified, then it will be beneficial for the public to get exact information about the financial position of the company, and then accordingly they will invest their money. Verification of profit. It is very helpful for determining the true profit on business resources. The reasonable profit attracts the investor. Now, this verification of profit, this is beneficial for shareholders, those people who already invested invested money in this company, who are the shareholders of a company. So this verification is beneficial for them because they will know the exact profit, the true profit on business resources, that what is the true profit of the business. And the next thing, that if public knows about the exact profit of the company and profits are high, so these high profits will attract the investor, new investors will be attracted towards the company. So this is another advantage of verification, that if we verify profits, auditors, they are verifying the profits and then they are giving the reports. So on the base of that report, then public, they are taking their decisions, and the existing owners or shareholders, they will know about the exact profit of the company. The next advantage is liabilities verification. The auditors are also verifying the liabilities. The auditor verification of liabilities is very useful for business owners. They will know about the position of the liabilities of the company. When they know about the position of liabilities of the company, if the volume of liabilities are small, then it is good indicator for business. If the volume of liabilities is low, it shows a healthy financial position. But if the volume of liabilities is high, it shows a weak financial position of the company. Business position, you know about business position, financial position, balance sheet. Verification of asset and liabilities disclose the real positions of the business. So auditors, they are also verifying the balance sheet items, so it will disclose the real position of the business. If asset value is greater than liabilities, then business will be stable, otherwise not. Now you people know about this, that if assets are high, assets is equal to liability plus equity. Now you know, if assets are more, suppose assets are 100,000, liabilities are suppose 20,000, and equity is 80,000. So from assets, when we will deduct liabilities, 1 lakh minus 2 lakh, so we got 80,000. If assets are more than liabilities, now assets are 100,000, liabilities are 20,000. So it shows that assets are more than liabilities. So it shows a strong financial position. And if the situation is opposite, so it will show a weak financial position of the business. True picture. Verification. After verification in his report, auditor gives the true picture of the business condition through financial statement. So if auditor is coming and he is verifying each and everything, then he is presenting his report. In his report, it is not possible for the auditor to give his opinion about the assets without verification. And this report that auditor is preparing, we discussed about this, that the end result of audit is making a report, giving an opinion. So auditor cannot give his opinion without verification. If he will not verify, he can't give his opinion. We discussed about this, that his opinion, the opinion of auditor, it will be objective and it will not be subjective. We discussed about objective, that what is objectivity. Objectivity means that on the base of facts and figures, on the base of data, you're giving what your opinion. And subjective means that just looking at the organization and just giving your own opinion. Yes, it is good. So it is subjective, on which there are no facts and figures. So this is subjective and objective. So auditor, without verification, he cannot give his opinion. He cannot give information about the true picture of the business. The next thing is, so these were the advantages of verification. That through verification we can check on fraud, we can evaluate the performance, we can utilize assets properly, because people inside the company, they know that there will be verification, so they are not misusing the assets. Safety for creditor, it will give safety. This verification will give safety to the creditor. Creditors are those people from whom we are purchasing goods on credit. So they are checking each and everything, and then they are presenting their opinions. So creditors, they are studying their opinions, and on the base of that, then they are giving goods on credit to the company. Then protection to the lender, if books are audited, so the company, they can't misguide people about their financial position and about their profitability. So it will give what protection to the lender. When lenders, they are giving you loans, they will give you loan on the base of this what audited financial statements. Proper valuation of assets. Assets, if there is verification, so assets will be properly valuated. Proper recording, there will be proper recording. Each and everything will be properly recorded. Benefit for the public, there will be benefit for the public. If the public want to invest money in the business, so they will study the the auditor report, and then on the base of that, they will check the financial position, and they will check the profitability, and then they will invest money in the business. Verification of profit, liabilities verification, business position verification, and true picture. So we discussed about all these things. Then there are different methods of verification. Now what are these methods? What are the procedures of verification? Now following points are important in procedure of verification. These are some points. These are some 16 points which are important in verification. The first point is verify the asset register. There is a book in the company which is called asset register. In that asset register, we are keeping record of all the assets which are purchased and all the assets which are sold. The asset register should be collected by the auditor from the company. They will demand that thing from the company, that I want to check the asset register. It can be used to verify the sale and purchase of assets. I told you that all the assets which are purchased and all the assets which are sold, their information will be available in the asset register. The entries in the register should be approved by officer of the company, and he will check whether when company wants to purchase an assets, there will be an approval of an officer, and if company want to sell an asset, there will be an approval of that thing. So they will check that asset register whether these approvals are available there in the asset register or not. So one procedure used in verification is verification of asset register, that they will verify the assets register. Auditor. Schedule of assets. Schedule of assets, it is a book in which there is information about all the assets of the company. The auditor can collect the schedule of assets and can verify the various things like opening balance of the assets, addition, and other informations relating to the asset. So there will be complete information about the assets, their opening balances, if there is some addition to these assets, and some other information relating to assets. The schedule must be signed by the officer, and it is important that this schedule must be signed by some top management authority. Physical verification. Now, physical verification is like going personally and checking that asset yourself. Like suppose physical verification means that there is written that there is a piece of land, there is building, there is machinery. So auditor, he is personally visiting that place and checking that assets personally. So the auditor can go to that place and verify the asset where that is lying. Means he is going to that place where that asset is basically present, and he is checking that asset. Suppose there is written that there are 5 vehicles, so he is personally going and he's checking that those vehicles. If there is building, so he's personally going and he's checking that building. Management helps the auditor for verification. In this physical verification, management will help the auditor. Now the next thing is the verification, verify the custody. Custody means that who is using these assets. Company, keep in mind, for every asset, they will give it in custody of something, in care of something. So verify the custody. The custody of the asset can be verified by the auditor, that they are in the hands of related in charge or not. Keep in mind, company will give custody of asset to some in charge, that you are responsible for this asset, the maintenance, the whatever that is, the maintenance, the repair, each and everything. So it will be in custody of something, a person will be in charge of that thing. So he is checking whether it is in the hands of related in charge or not. Addition of assets. The new assets purchased by the company must be recorded in the books of accounts. Now he will check that if new assets are purchased, these are recorded in the books of accounts. There is an entry, there is a journal entry regarding that or not. This addition must be verified by the auditor. An auditor must verify this addition, that addition is made in the books of accounts or not. So addition of asset must be checked by the auditor whether the entries, journal entries, are made in this regard or not. Disposal of asset. When assets are sold, we call it disposal of asset. The auditor can verify the entry of asset which is sold during the year. Now, those assets which are sold, the auditor will check whether entry is made regarding this or not. If it must be sold on profit or loss, whether the company made profit on the sales or the company made loss on the sale. So this thing will also be verified. Disposal of asset. Whether the assets which are sold, their entry is made in the books of accounts or not. And if the entry is made, whether it is sold on profit or it is sold on loss. Transaction approval. The auditor must verify that every transaction is made by the order of competent authority or not. Keep in mind, each and every decision is taken in the company by a competent authority. Whether the top management, whether the middle management, somebody will give approval of that thing. Suppose a company is going to purchase a piece of land. So there will be approval of the board of directors. If they are going to purchase, suppose they are going to purchase a building, they are going to purchase shares of other companies. So there will be proper approval of that thing. Transaction approval. If any transaction is occurring, so there will be approval of that. So here they are checking the approval. The auditor must verify that every transaction is made by the order of competent authority or not. He should verify the signature on every document. Keep in mind, every decision taken in the company, it is basically approved by someone. So they are going to check the approvals and they are going to check the signatures on every document, whether the proper approval is made or not. Whenever company is purchasing something or whenever the company is selling something. Like, take an example, like suppose I need 1 month advance salary. Now, cashier, he don't have the authority to give me 1 month advance salary. So someone will approve it. So who will approve it in our university? The top management, the VC. So VC, Vice Chancellor, he will approve that thing, and then after that, the cashier, he can give me that 1 month advance salary. Without approval, if someone is doing something, then that will not be considered good. The next thing is verify the cost. The cost of assets should be verified by the auditor by checking the documents like voucher and journal entries. So he will verify the cost of each and everything which is purchased. And this verification is done by using vouchers and journal entries. I told you about voucher. Voucher is evidence of a transaction. So this is evidence. With this evidence and this journal entries, we can verify the cost of whatever the thing is purchased. So he will also verify the cost, that those things which are purchased, what is their cost, the verification of cost. Then the next thing is verify the internal control. We discussed about internal control in detail, that what is internal control. So the auditor should verify that internal control system is applied or not. Auditor will check this thing, that whether the company is applying the internal control system or not. If it is applied properly or not. They're also checking whether the internal control system it is effective or not. They will also check this, that whether the internal control which is applied inside the company, whether it is effective or not. So he will give his opinion. He will check whether it is applied or not. First thing, he will check whether internal control is applied or not. And the second thing, he will check that whether it is this internal control which is applied, it is effective or not. Loan on asset. What is loan on asset? Suppose you want to take a loan from a bank. Now for this loan, the bank is demanding some guarantee. So you're telling the bank that, okay, I have a building and I will keep the documents of the building with you. You will give the documents of the building, documents in guarantee, that if you will not return the loan amount, the principal amount, bank has the authority to sell your building and will recover their amount. This is called guarantee, and this guarantee is basically called mortgage. Not like this, M-O-R-T, gauge, G-A-G-E. So then this guarantee that you are keeping with bank, that is called mortgage. So here he's talking about this thing, loan on assets. The amount of loan taken against any assets as a security must be verified by the auditor. Auditor will verify that the company took a loan on an asset. It can be also verified from the lender, and then he will verify it. He can also verify it from the lender. He will call the bank that whether this company, this ABC company, they took loan from you on behalf of this mortgage of building or not. So verification, he can call, he can personally visit the bank and ask from them about this thing. Verify disclosure. You people know about the disclosure. In case of disclosure, important information must be disclosed in the notes below the financial statement. We call it disclosure. So in case of disclosure, auditor should verify that all disclosure requirements have been followed by the government law or not. He will check whether in disclosure the government laws, the financial international accounting standards and international financial reporting standards, their laws are followed or not. So he will check all the disclosures, and then in disclosures he will check whether the requirements have been followed by the government law or not. Requirement have been followed of the government law or not. whether the requirements are followed or not. I think for today it is enough. We still have much more things in this topic. So, inshallah, in the next class, we'll talk about the title deed, depreciation, external verification, capital and revenue verification, stock valuation certificate, and then we will talk about steps of checking the share capital of a new firm. Inshallah, in the next class, then we will talk about all these things. Have a good time.